there's anything of note in that, apart from the usual warnings and blah, 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 blah. No, nothing I can see out of that. So we shall move on from that quite quickly. Yeah, all good. How's everyone doing? Nice and chilly where you are, Kay?
Oh, yeah. It's freezing.
Yeah, lovely. Go on then, Dale. Tell us what the temperature is in Greece right now.
Yeah, it's dropping slowly. 15 today.
Oh, 15. Oh, right. Okay. Yeah. We'll do a swap one day.
So yeah, we got some football today, so that's good. That's the main event, not the CPI, obviously.
Yeah, after CPI. So yeah.
And tomorrow, Fed? What Fed? No, it's the other semi-final, right?
Yeah, exactly. Oh yeah, will that be on while the Fed's on? Oh dear.
Yes. Actually, no. It's going to.
News.
Oh yeah, it starts exactly at the same time. Yeah, 7 p.m. UK, I think.
No consideration, those central bankers.
Absolutely.
For the important things in life. Anyway, we'll have to watch two screens. Sorry, mate.
I got kicked out, so sorry, guys.
It's okay.
That's okay. We've just voted you for covering the Fed while we watch the football tomorrow.
Oh yeah, no problem at all. I've got no interest in football, mate. But I will have to watch those Fiji elections, so I might miss.
Definitely. Right. Enough joking around. Let's get into the serious stuff. As serious as it can get. I'm going to start with the most serious headline of the day, and that is that Turkey President Erdogan expects inflation to slow to 40% in a few months, down from the current 84%. So good news coming in.
Do you know what else he said? He said he said that Turkish missiles can reach Athens, which is a little bit worrying.
Yeah, well, they've got bigger catapults, have they now? You better get your tin out, mate.
It's the long-standing tradition when they have internal issues, they always turn to us, their lovely, friendly neighbors, and threaten us in some way. But anyway, it is what it is.
How far can your missiles reach?
I don't know, probably my backyard, something like that.
Yeah, usual stuff going on there. But anyway, 40% inflation, that's class as a result these days. Good luck to him with his ergonomics, as we call it. He might even stop cutting rates to fight high inflation. Still can't work that one out, but there you go. Right, let's go over to China and more easing news from there. Hong Kong and China are going to start quarantine-free travel from January. Hong Kong will also end its COVID contact tracing app requirement. Similarly, that news is happening in China as well. And Hong Kong are also going to scrap their 3-day monitoring period for arrivals. So things continually easing and opening, however you want to call it, over there. However, it's not all plain sailing. Something we mentioned in the last couple of weeks is the possible side effect from reopening is a surge in cases. People contracting the virus in more cases now that they're not locked down so rigidly. And Reuters wrote the piece saying that firms are straining to keep operations running due to a surge in COVID cases. So as I said, this is the flip side to the reopening, that if cases surge over there, activity may contract because firms will have to go into shutdown, or they won't have the workers there to do the jobs. So, out of the frying pan into the fire sort of thing. That's something that's going to need monitoring if there is a big, huge wave of COVID cases. There is a problem with vaccines over there. There isn't a huge take up compared to other countries, and that might be an issue, although it seems that Western meds that counteract the effects of COVID, so not vaccines just yet, but meds, are potentially making their way into China. But it is going to be an issue that they're not out of the woods just yet, even with the reopening. And further to that, there's been reports that China has postponed a key economic policy meeting due to happen, and that has come because of a spike in COVID cases. This is a meeting that's often attended by Xi, where they decide economic policy for the foreseeable future. Big announcements are made at the end of it in the Chinese state media. So this is a pretty big meeting, and it's reporting that it potentially has been cancelled due to COVID cases. Over to Japan, and I'm more watching this for a level of interest rather than any real market moves, aside from the fact it potentially means more fiscal spending from Japan. And their defense, this 43 billion yen they want to put aside for defense spending and how they're going to pay for it. They're still arguing whether it's going to be tax hikes or other stuff. So one press source, Kyoto, says that the ruling LDP party are looking at raising the corporate tax to 5% to fund this defence stuff. In another headline, someone saying that they're mulling construction bonds for part of the defence spending. So this defence spending is on the cards. As Kay's Fonda pointed out, it is more fiscal easing in a sense, which comes on top of Bank of Japan easing. So no tightening of conditions there at all. But it's just how they're going to spend, how they're going to pay for this defensive stuff could be significant for what the government does to taxes, so on and so forth. Coming over to the SMB, and we were talking about this being the SMB meeting this week being the potentially biggest risk of something coming out of left field in terms of the size of hikes among the central banks this week. A Reuters poll pointed out that the majority of people they asked say that the SMB will raise by 50 basis points, but there is a larger move possible. Now, numbers wise, out of 28 eggheads asked, 18 are going for a 50 basis point hike. 9 again are saying that it's going to be a 75 pip hike. The other one is probably sitting there twiddling his pencil in his ear, so we don't know what he or she is doing. So there is some expectation there for 75 pip hikes. We were looking at the rate probabilities yesterday, and we were pricing just a 50 or 25, which made it, in my opinion, a bigger surprise if we got a 75. But there are some who are potentially looking for 75s that may lessen the impact of a surprise move to 75. It will still be pretty big a shock, or a big variation to expectation, should I say, and that we're keeping an eye on. And I'm thinking that dollar Swiss may be one of the better trades to have among all these central banks this coming week. Maybe talk about that in a bit. Over to the good old lot at the ECB. Again, staying on the financial stability side of things, they've warned that Eurozone banks are at risk of mounting bad loans and a funding squeeze due to rising interest rates and higher inflation and a likely recession. Some might say that's a bit of a no shit Sherlock comment to make there. But that's come when, as they've published their banking supervision priorities for next year. Looking at the Bank of England, traders have raised their bets on where the Bank of England rate may go to or may peak. We're up to 4.75 pricing for where rates will be come August next year. That's up from around 4.5%, and it's apparently the first raise in those expectations for 2 weeks. This has come amid some data we saw this morning in the UK, jobs data and wages data, and we'll take a quick look at that here. It was a bit of a mixed bag in this data, in my opinion. We saw the claimant count, so those people claiming for unemployment, rising quite significantly, 30.5k. It had been on the low side for quite some time. However, the unemployment change was better. The payrolls number was running at 107,000, so showing people going onto payrolled employment. Now, that in itself can be a bit of a mixed bag, because that can contain seasonal hiring, people getting jobs for the Christmas period in shops, restaurants, that sort of thing. And it also doesn't account for people who may be taking secondary jobs. So it doesn't mean that 107,000 is 107,000 new people. It can just mean the same people taking second jobs. So it's a bit mixed there. Now on the wages front, they were much stronger. Wages, including bonuses, up 6.1%, so higher than last month, but not as high as expected. Stripping out the bonuses, 6.1% also beating expectations. Now, again, there's caveats in this. A lot of this wage gain was down to public sector pay rises, and those don't happen often. Public sector always lags private sector in wage levels, and very rarely do you get wages up this high. So this could be a one-off period where there's been a jump in public sector pay that may wash out in the next couple of months ahead, maybe into January. For the Bank of England, the unemployment rate rose to 3.7%, and as I said, those claim numbers were higher. So there's a little bit of everything for the Bank of England. For hawks and doves, they've seen weaker employment. They've also seen stronger wages. That's the definition of pressure for the Bank of England. How high do they hike? Do they go of 50? Do they go 75? Do they go 25? We know from yesterday that there's potential divisions in the voting of what the individual members may think. This, in my opinion, adds to that confusion. So from here, the Bank of England still may be a bit of a mess when we get to it on Thursday and find out what they want to do. Over to the Bank of Canada, and our mate Stiffers said that interest rates have begun to work their way, but will take time to feed through to the economy. And if high inflation sticks, much higher rates will be needed to restore price stability, and the economy will have to slow even more sharply with inflation running well above target. He says the risks of people and firms expecting persistently high inflation is greater than the risk of driving the economy into an unnecessarily painful recession. Increasing rates rapidly to rebalance supply and demand and keep inflation expectations anchored is our best chance of restoring price stability. Now, this particular comment ended with is our best chance of restoring price stability with a severe contraction. I'm not sure if that was the right comment or it's supposed to be without a severe contraction, but that's what the press has been reported. And then he played a bit both sides of the fence. If inflation forces are stronger than we expect, we will start to see inflation coming above our forecasts and will adjust our policy targets, our policy settings to hit the 2% target. On the other side, he said, if the inflationary forces return and inflation starts to come in below our forecasts, again, we will adjust policy to hit the target. But for now, inflation is well above target and it is a long way back to the 2% target. So maybe a little bit more hawkish than what we've seen so far. From the last Bank of Canada, it seems they are pretty close to going on hold, but Tiff wants to keep the rhetoric in play that they are still prepared to do more and carry on with hikes if necessary. So trying to keep a bit of balance there. Over to the Fed, there was a New York Fed survey on inflation expectations, which declined across all horizons. However, income and labour market expectations strengthened. I looked into this report this morning a bit deeply, and particularly looking at the jobs area. And the mean perceived probability of losing one's job in the next 12 months decreased by 3 percentage points. And then the mean perceived probability of finding a job if one's current job was lost increased 2 percentage points. And that's the 4th consecutive monthly increase and the highest reading in that number since Feb 2020. So it seems that US citizens are not scared about losing a job. So they're not fearful of unemployment. And they're also confident that if they did lose their job, they'll be able to find another one. So that keeps the sentiment in the jobs market pretty strong. Confidence is high, and we've seen that from the jobs market in the numbers themselves from the NFP and the like. So again, we're not looking like we're close to seeing any form of really bad news coming from the jobs market as we sit here today, but as we all know, things can change. Now, our old mate Timmy Leaks was out yesterday afternoon as well. A lot of people have been keeping an eye out for him to see if there's any clues to the FOMC. There wasn't really much in his story in terms of setting a stall out for what may come. But he said that the Fed is potentially divided over how much further they should hike and how long they should keep rates up. That's pretty much running along the theme of what we're seeing in markets, trying to guess, are they going to have to cut in 2023? Will they get as high as they're going to say rates will go? So that's all the questions being asked that will be decided on Wednesday, hopefully. Now, talking of the inflation data, and JP Morgan's one of their trading desks out with a little bit of clickbait overnight. They say they see the S&P rallying up to 10% on soft inflation data. And once that headline sucks you in, they then say the most likely scenario points to a market gain of 2 to 3%. So, as I say, get the clicks in and then deliver the less inspiring news. It is possible, obviously, soft CPI numbers today, and we're going to see the stocks rising again. We're going to talk about that in a moment, you know, how to look to trade these numbers coming in and out. But for the meantime, guys, you got any items you want to throw across to us?
Nothing in terms of announcements and data and stuff. Just my 2 cents regarding the central bank action. I think the Bank of England, you talked about a couple of potential outcomes. I think they've been always surprising to the dovish side, right? Whenever they can, they're dovish. Granted, they did have other central bank heads before. You had the unreliable boyfriend who was incredibly bad, Mark Carney, obviously, at that. And but I still, this is something that's characterized the Bank of England for a while. If they do find, for at least the last couple of decades, I mean, if they do find a reason to be dovish, they'll take it. So if there's a choice between a 50 and a 75, I personally think they're going to do 50. There's no, obviously inflation is high, but the way they see it, there's no rush to do bigger hikes. And if the Fed is going to 50, well, we're going to 50, you know, that kind of thinking. The Fed, I think it's a done deal, 50 tomorrow. No doubt about it. They never want to surprise markets. The question remains, what happens after that? We're pricing another 50 after that in total. Do we get a 50 and a done, or do we get 225s, or do we get more? I've said it before, I'm going to say it again. I think the risk is for the market to reprice a higher terminal rate for a little bit longer than it currently is. Whether that will actually transpire is a different story. But I think the market will go ahead and price that probably within the next, you know, in the short term, because I do think that Powell is not going to be as dovish as expected. So be careful. You know, I think that's the risk. Now, if Powell is dovish tomorrow, I think all bets are off, and I'm going to step in and increase my longs in metals and see if I'm going to get bearish the dollar. So I'm going to be looking for chances to short the dollar, but I hope we don't. I hope we don't get that. I hope we do get a hawkish or at least not dovish Powell, because I would like to sell into dollar strength when we get it.
Yeah, exactly my thinking too. Kay, what's your thoughts on things?
You were asking about any other headlines, right? So there's something that I read about Japan and some Japan economic watchers saying that if the Bank of Japan, because this pressure from a little, well, not that much from the government, let's be clear, but there's a bit of pressure mounting and gradually mounting for the Bank of Japan to start to change things. But they said that any changes, and they weren't even talking about massive changes where the Bank of Japan would start to raise rates, Fed or ECB or whatever style, but any major kind of changes would potentially cost the Japanese investors market up to $1.1 trillion, which is an absolute gigantic amount. So I trust Kuroda has read it because he reads probably the most dovish stuff. And then there was this interview of Shirai, which is an ex-BOJ official. And she said she also expects that if ever there are changes made to the Bank of Japan monetary policy and the framework, because we have to recall that Mr. Abe, Prime Minister Abe, got elected in 2012, right? So, and we are arriving at the 10-year anniversary of the framework that has been put in place in the Bank of Japan. So we might see a review of the framework, but she also said that she does not expect lots of changes in the framework. And I think that's somewhere what keeps the yen a little bit on its toes right now. And also, just an observation there is that I'm starting to, of course, and I also said it's likely due to the fact that Bank of Japan is keeping their hands still and the rest of the central banks are continuing to hike. But I see some really very, very tentative signs that yen may start to show signs of recoupling a little bit to equity moves, because we've seen the dollar yen volatile as it is, but if you look at all the cross yens, they are pretty well beat against virtually everything. And you look at the equity markets and of course, the energy market is as well. They have come up, so it's just something that I'm noticing. And then those two little things that I saw. Also, last word on China is that I've seen that the Chinese local banks, they are running on half the staff right now because the other half is at home ill with the virus. So whatever the Chinese official medical staff may say, it's not just the flu, right? So that is like a couple of things that I saw overnight. Now, looking forward to CPI. I've seen quite a few people calling. Well, I mean, it should come off because that's the trend. It should come off. But I just would like to say, as I said in the room this morning, I think for today, the surprise trade, looking around assets globally, looking across the board, the surprise trade today would be a not so weak CPI. It seems the market is really gearing up towards those weaker data. Probably with reason, and as Stelios already several times said that he expects CPI to come off in 2023, but it has to start somewhere, and it's already started. But it seems the market, to me, is gearing up for a decent decline. So the surprise trade would be that it's a little bit more sticky, and if it's more sticky, then and I'm not saying that's going to be the condition for the FOMC, but if it's a bit more sticky and the FOMC comes out, we are continuing and we need the whole thing to be, the whole curve to be positive compared to inflation. We need, and some comments about, the financial conditions perhaps that weaken despite QT. The combination of both, if CPI does not come in as low as expected, could be quite explosive for the dollar, in my opinion.
Yeah, no, I agree with that. I think it's going to be. I mean, in theory, CPI should continue lower. You know, we got the PPI last week for November, so that's come ahead of the CPI. That was lower by a decent chunk. So it stands to reason that the trend is going to remain. But you're right, it's about the scale of the moves that we get in the CPI and core CPI as to what the market reaction will be. So let's take it from one extreme to the next. So the most bullish for the dollar, hawkish for the Fed, is CPI and the core number coming in above last month. That would blast expectations and, you know, destroy a bit of the narrative that maybe CPI has peaked. So that's the extreme case on the upside. If you get that, we're going to see yields jump. We're going to see the dollar jump. Next from that is if it does confirm lower, but comes in above expectations. So, for example, comes in the core at 6.2%, comes in somewhere between 7.4 and 7.6% in the headline. If that's the case, you're probably going to see a bit of mild dollar buying. Yields may be moving up. As Kay says, that may be a bit of a surprise. It's not going to probably be a huge reaction in price moves because it would still confirm that inflation is dropping and we are still trending lower. It's just not going as fast as the market expects. In that case, I potentially would expect to see rallies hit in the dollar. Not saying it would send it all the way back, but they're not going to get too far. And conversely, on the other side, coming in expectations or lower is going to be the test for the dollar and yields. Can we see dollar yen pushing back down to those lows that we saw before? It's going to take a real big drop in inflation, I think, to get us anywhere down there. If we look at yields and dollar yen as our straight dollar trade, these lows are important. You know, we've confirmed these lows on all the news that we got since the last FOMC, Powell, Brookings, you know, CPI reports, PPI reports, PCE reports, data. We made these lows on that news. It's going to take bigger news than that potentially to get us back down here. I don't think that's going to happen over this CPI report unless we, you know, CPI drops really significantly. If we start getting the core down at 5% to low fives, if the headline's down at 6%, something like that, that's a big move. That's potentially when we see a bigger sell-off in the dollar. But otherwise, I think we're going to remain well in these ranges. As I said, looking at yields, we had the move down. We called it priced all the prior news and the CPI reports and the Powells. It needs to do a lot more to get those yields back down there. I don't think it's going to happen over the CPI. It may happen over the FOMC. So for trading it, those sorts of levels are your clue. If it's a bad number or a much worse than expected number, i.e. inflation is much lower, those are your levels that are your guide. In yields, if we can't get back below 3.4%, we're going to stay in the range running into the FOMC. And you can pretty much take that across all your dollar pairs. You know, if you're looking at euro dollar, we've got the 106 area. If we can't break that on a big lower move in CPI, well, then you've got to think, well, what is it going to take to break that area? Move on to the Fed. Same for something like Aussie dollar and the 68 level. We've tried. We can't get and hold above it. That's your marker. If we get above there, then you've got some other levels to look at. So it's all about just matching the moves, the size of the differences and variation in the data to how big a move you're going to get in markets. And then you look at your levels, you plot your levels, and those are the levels that ask the question, can you break those levels or can we not break those levels? And then you trade them accordingly. You guys setting up for anything in particular? I know I probably asked this yesterday, but anything changed since yesterday? I know, Kay, you've got into some dollar China. Is that on the Chinese stuff or a bit more on the US stuff?
I did it on, when was it? On Friday or so I entered, yeah. On Friday, I think. I'm only half convinced about their reopenings. I'm especially a bit worried about the fact that so many people are catching it, and we're going to get under reporting of the numbers. But if you look at the data of shipping and stuff, it's still very weak. I think there's a fair chance we're going to have a break back above 7. Of course, the dollar is going to have a say in it, and perhaps a bit later, well, in an hour or so, I will perhaps like sell another dollar against it. I don't know which one, perhaps dollar Swiss or so, to neutralize the dollar just over the data. Yeah, I think for as long as it holds, if you talk about dollar China, for as long as it holds 690, I think there's a fair chance we are going back above 7. PBOC is also not trying to guide dollar CNY lower, so that supports my view for the time being.
Yeah, reading that story this morning about the COVID cases, rising and impacting, potential work over there, that did have me thinking about maybe jumping into a long. I don't like it this close to 7 though. I would have liked to get in longs down at that 691, 690, but we didn't get down there. But I think you're right, and we've had another crack at 7 again today, and it's held. So there's obviously a bit of a wall there.
Yeah, for sure. But there's also, I'd say it's also that has to do with the dollar side as well today and tomorrow. Market is if you look at most of the instruments, the dollar is a bit on the defensive. Cable not too far from 123. Euro dollar holding above 105. I say the only outliner is really the dollar yen because of the yen crosses. But yeah, the dollar is still sold on rallies. What we expected actually going into this week, and we've been saying that last week as well, which is what is happening. So
yeah,
that for the dollar China, I think. Yields will be moving. Yields will be moving today. Tends back around 360. 360 is not a huge level anymore. I'd rather. Well, it's still a bit of a level, but okay. I don't think it's a definitive or defining level 360. It's rather going to be somewhere in the 370s or so on the top side. But if we start to go back for a starter below 348, 350, and then especially through those prior lows, that's going to be a worrying sign for the dollar, in my opinion. Not sure if the CPI today can get more than 10 BPs or so out of the US 10s. We will see.
Yeah, and dollar yen just for now seems to be complete lockstep with yields, as it often does into these Fed events and stuff like that.
Yeah.
Nikita asked about the S&Ps. Let's have a look at that.
Strong bounce, because I was going to ask the same thing, because I was off yesterday, a part of the afternoon and evening, and I was half surprised that that I left when S&P was around 39, 35, 40 or so, and then walking in, it's like close to 4K. I was a tad surprised to see it this high, and I haven't seen any real data, or just the market expecting lower CPI probably.
Yeah, Stel, you got any info on that move up in
on the
S&P?
Not really, no. I mean, we're seeing risk
about a bit.
Yeah, risk being bid overall, but yields are unchanged, dollars unchanged. No, I don't know. Is it position squaring ahead of the CPI? I don't know. I don't have an answer.
Yeah. Nikita, what double bottom are you seeing? Are you just looking at this that's happened over the last few days, or around this 39, 10, 20 area, which is looking a bit, cool. That's looking a bit solid for support there. I'm not sure why we've got this bounce as well. You've got to look at that number. If you think that CPI is going to be coming lower, and that's the trend, and that's going to force the Fed to ease off the gas pedal, then that's your dip area for the moment. So anything down there, where you're wrong. If you're through 39s, that's where you're likely wrong, and potentially where you see a steeper pullback. So you got your levels, you know what to do with them. Alan says, a bit confused why one selling off with COVID reopenings in China overnight, unless it's already priced in. Yeah, I mean, I think we have priced a lot of the positivity. That was the big move down that we've seen. But as mentioned, it's not all going positive way. The cases are rising and potentially rising significantly. So they could be hit with a strong wave of COVID cases, which, as mentioned, has the effect of slowing down the economy, because it slows down activity. If factories, lose 50-60% of their workforce, that's going to impact just as much as locking down that factory because of 2 cases. So it's 6 of one, half a dozen the other, and I think that's potentially what's going to be helping the one weaken a bit in this scenario. But similar situation, we've priced all the good news all the way down from the 720s. It's going to take a lot more good news to see $1 coming much lower. But as Kay mentioned, we've got the dollar on the other side of it. Now, quick one that I've mentioned I want to look at is dollar Swiss, because it is getting my interest here. With the potential for a bigger surprise than the market is really expecting, a 75 pip hike. It could be a case where if we get a decent rally in the dollar, that might be one to look at a short running into the S&P the next day. Again, it's going to be a question of scale. Is the S&P going to trump whatever the Fed has done previously? Probably not, but it might be good for just a quick reactionary trade. Probably a bit pie in the sky, but if we get dollar Swiss up towards the maybe 95s, 50s, something like that today over the CPI numbers, I might think about getting into a little bit of a short there, just a little bit of a build, see what the FOMC does, and then see what we do going into the S&P. Alternatively, if I'm not feeling that I want to jump into anything straight away, I'll let the CPI and the Fed do its thing, and then if we get a rally post Fed, then maybe look to sell it then and get a reaction over the S&P. So this could be a bit of a mover. So that's one of the trades I'm going to be looking at for all these central banks that might be a bit cleaner than the others. Kay, you're looking at dollar Swiss 2 maybe as a bit of an offset for yuan. What do you see from the action potentially from the S&P? Is it going to be good for a snipe, do you think? Hello.
Yeah. Oh, sorry, my microphone was off.
You fell asleep again, didn't you?
Yeah. As I was saying, there's always a surprise, a risk, right, in trading, a surprise, because if we don't get it, it could potentially hurt the book a bit. But yeah, I actually think there is a chance that they do a bit more than the market expects, especially that they only meet like every quarter or so. And the latest comments, or the last comments by Jordan, were still pretty how shall I say, hawkish. So yeah, I'm thinking like this. It's either dollar Swiss or could be euro Swiss if ECB is not that hawkish, or I don't know, Swiss yen or so. But yeah, perhaps just for the afternoon, it could be a decent protection for the dollar China. But then, since it's ECB, we're trading, could just do euro dollar as well. It might have the same effect. If you want, I can look at a couple of things going into CPI, and then already perhaps look just a little bit forward to the Fed. I'm not going to take too much time, but just
go ahead, mate. Go ahead.
All right.
While Kay grabs the screen, I think just to give a bit of general advice. Yep, got it, mate. Just to give a bit of general advice on trading this, you've got to take these two events a bit separately. So if you're going to trade the CPI for what it is, then trade it, and then think about what it means for the Fed after. You don't want to be sitting in the trade the wrong side when potentially the Fed can then throw you out. If you get some profit trading the CPI, take some off the table. If you want to run a bit into the Fed for interest, then do so, but make sure you've got yourself covered, got some money in the bank. You don't want to lose it all on the FOMC. Over to you, mate.
Yeah. Okay. Yeah. The one thing I wanted to just to add to that, if you get a strong CPI today or a higher CPI, I think then it's a recipe for the dollar to explode tomorrow, because then that's going to give the FOMC boats enough ammo to stay hawkish. Yeah, just about this double bottom in the S&P, which Nikita pointed out. There's also a trend line coming in there, so we are in a bit of a shorter, well, it's still formed from October. We are in a bit of an upward channel here, so we have this big 41 level that kept, and now we have the 39. So you have like 200 points in to play with. Of course, this 41 level is going to come gradually down, but psychologically, I still think 41 is probably going to be what the market is looking at, even if we break above. So be a tad careful with this, because as I said, expectations are for the CPI to come off and this to rally again. We've already rallied 2.5% from the low. So I'm not sure how much front running has already been done and how much is still left to do. We always have to speak conditionally in these markets, because we're also starting to run into we have the CPI, then the central banks, then we start to run into year end. This could get very confusing. This dollar yen. So we have this top now confirmed around this 50% FIP of the latest decline from 142 to the lows. That seems to be a decent enough level to closely monitor over the day. If CPI would come out a tad higher than expected, I'm expecting this to give way and to at least go and have a look what's happening in the 138.65.95 zone, which is then the gateway to 140. But it has to decently surprise to the top side to already break above here, in my opinion, because it has been a bit of a traffic zone as well in the past. Downside, well, just a tad in between, around 137.20.30 perhaps, but really it's about the big figures. 136.95 figure, that's going to be the support. If CPI comes out lower and drags the yields down, there's a possibility to go and have a look at what's happening around this 136.25 trend line. If in turn it's really lower, then I wouldn't rule out a move back down to the mid to low 135s. Yen has been volatile, so 100 pip move, 150 pip move is not to be excluded, okay, on this CPI number. So keep an eye on that one. And then there's one that I'm finding interesting, as the Kiwi. And the Kiwi, even though RBNZ has again warned consumers as well, as we see Aussie Kiwis is just ticking slightly higher this morning, but has been warning a bit. But this Kiwi has been really behaving very, very well through the whole process of the dollar correction, and we are ahead of pretty decent levels. So on the tide, this is really on the tide, right? I'd watch this 64.0520 for a starter, and then 63.35 on the downside. But that's one that I'll be looking at in case of a disappointment on the CPI, just because it has held up so well. If we start to break above this 64.40.50, and you can see it's been the prior high here, It's been a traffic zone here, and it is the 61.8 of the move from 70 down to 55 is also around 64.5. So keep that 64.5 in mind on the Kiwi dollar, especially if we get a really weak CPI and which would force the FOMC into a more dovish side. So 64.5 on the Kiwi dollar. I'm really going to pay very, very close attention to it, because it could be that we are moving like through 65 if we break there, and why not even higher. The other one is the Aussie. Sorry for my chart. It's a little messy.
So you mean it's really good at football?
Yeah.
Messi.
Exactly. Yeah.
God.
Sorry, that joke. Sorry,
I'm not doing Christmas crackers this year, mate.
Yeah. Thank you so much, Stelios, for your valuable input. So yeah, the 68, the figure, as we all know, and then you have like a bit of confluence here around 68.75, and as Mr. Ryan rightly pointed at it, it is where is it? It is also
It's in there somewhere, mate.
68.75 is also the 38.2 of the whole 2021-2022 decline. So 68.75 is going to be a big level on the Aussie dollar if ever we get up there, because there's a confluence of quite a few things. If we fail, or if we get a better CPI, more sticky or more higher CPI, based on my view about the CNH, this could be perhaps a little more vulnerable than the Kiwi, for instance. And keep a close eye on 66.90, the figure for the Aussie dollar. If it would get down there, I think Ryan is rather watching the 66.5, which is a bit of a do or die level if we look at the latest lows. That for the Aussie, cover the dollar yen. Euro dollar is basically 107. Yeah, no, 106, sorry. 106, 15. We have a trend line coming in also from May highs over the February this year rebound. It's coming in very close around 105.80. So this 105.80, 106, 106.15, that to me is like really the zone to watch. It's a bit of short-term support here around the 105, the figure zone. So those are your two first markers. But I think it's got potential enough to create a bigger move. So if CPI would surprise to the top side, why not have a retest of mid 104s really? Yeah, what I was showing on the dollar CNH, we retested the 7. It's blocking up there. Dollar bears would say, or people believing in the China reopening will say, okay, it's an ideal level to sell, and in fact it is. For as long as we stay above 702 or 2.5, this could still be a very good sell for a move lower. I'm a bit in doubt re the CNH. In fact, to see the CNH materially strengthen, okay, we need better news, really better news out of China, and PBOC to start to lower the dollar CNY fixings as well. That's the basic idea, a bit mix between fundamentals and takes. Really, for now, perhaps the metals quickly. Gold, it's trading between the goalposts, right? 1807 again, 1765 is the one thing. If it would move higher, then there's again this 25-35 zone. If it goes lower, then we may have a quick look at the 17.25. It's pretty clean and clear, this gold, in my opinion. I don't have anything in it right now. Silver, I'm long. some smalls go today just in case there's an adverse number coming out, in which case I'll be looking at rather mid 22s or lower 22s to be reloading what I've sold on the way up. It's my long-term book, so it's in very small slices. But if, as Dale says, we are getting the combination of CPI and the FOMC bullish for metals, this could really very quickly explode, and I'm still ready for it as well. Cable brand, yeah, the cable is interesting around here. 123 and a quarter. Okay, support around 122.40.50. Breaks below there, then it's probably then we're might have a look again at 22 the figure 21.70. The bigger zone will be low 21, so we're a bit away from there. But if cable would start to break below 121s again, it could look a bit ugly. Top side, as I said, 123. The prior high 123.40s. We also have these prior highs here around 123, which have helped to cap cable lately. But if it would really explode, this wedge could take us up to 124, and then bigger zone around 125, in my opinion. So that's about the currencies for me. Also looking at the clock, I'm going to give it back to you, unless anyone wants to talk about something. Yeah, just to give you my global idea is I'll try to trade CPI and the FOMC together as a block, but it could be that both are a bit divergent. So I'm not going to put all my eggs into the CPI basket. And that's it for me.
Thank you very much, mate. I shall grab it. Anne was asking about euro sterling in the questions. Hitting a strong demand zone on the daily chart, is it right for a long or hold for now? Yeah, we playing another one that's pinging between the levels. We've had this sort of 85-70 area, which has been long time support. We had a move under that last week to another support area around 85.50. It's still going a bit sideways for me. If you want to look on the daily chart, I'm not sure it's going to give us much of a different picture. It's holding. You got the 200 DMA down there as well. We can't get through the 100 above. Ranging for me on this one. I still don't have a view of picking one side or the other for a longer term trade. I think the BOE is still going to have to hike higher than people expect and higher than they expect. And on the flip side, you've got the ECB, who may have to also get on a proper hiking path of higher hikes and keep them going for a bit longer. So fundamentally, I really haven't got a view on this either side. So if you want to know what to do with it, you've got the levels. You know, if you want to try here at this 85.70, you know, you may need to be quick in knocking off for some profits. If you get up to 86s, get up to 86.5, you know, look at these levels to maybe do the slice and dice. If we get a move under this 85.50 area, then potentially we're on for the low 85s, and the next support zone, the SNR zone down here, which has run 84.80, 85 the figure. For me, just play the levels if that's what you're inclined to do in the middle here. Obviously, take the Bank of England risk into the equation for Thursday. Maybe see how we are after that. Maybe the Bank of England have given us something to push to one of these extremes, maybe up to 87, maybe down to 85s. See what the price does there and take a trade accordingly, Anne. That's how I'll play it myself anyway. Stel, you got anything you want to discuss? Any charts you're looking at, or any you're looking at them to get?
No, nothing ahead of today and the Fed tomorrow, really. I think Thursday I'm going to have a look at a few charts with everybody. But what I was going to say is that the one currency pair for me that looks like it's on the brink of breaking either way is cable. So I'm probably going to be waiting for the Fed tomorrow, unless today's number is a big outlier. I'm probably going to wait for the Fed, because really I want confirmation from Powell if he's, if the Fed's going to be dovish or not, or hawkish or not. But the cable is the one that I'm looking at, and I think it's at a very important level. It's either going to break higher or retrace quite a bit lower. So on a hawkish Fed, I think this is the pair to sell, and on a dovish one, probably the one to buy. I probably say the short side has better potential, but again, it will depend a lot on Powell. So that's the one I'm looking at. And also, people will know I have been accumulating silver. I am probably going to, ahead of tomorrow's Fed, probably going to hedge a little bit of that by shorting bonds. So something like TBT on an ETF, which is an easy way to trade it. But because I think this risk is still for the Fed to be a little bit on the hawkish side. So I just want to protect that position a little bit. Needless to say, if Powell is dovish, I'm going to step in wherever the market is and buy more. So more of silver, and more of metals. Overall, I want to get long miners as well, so I'm taking it slowly.
Yep, sounds good, mate. And I was just showing all there because Dale had a great trade in this yesterday. Pretty much got it off the bottom. And said it could rally back up to 74, 75, and here we are. So he's had a real good winner there. Whether this is just, again, a bit of a, all the bad news priced in, a bit of a blow off the top, maybe even our mate Biden's bid has been in and buying for his SPR. But the 70 level looks like a pretty solid level at the moment. Where can it go from here, though? Is he going to go all the way back up to 80s? I don't know. These China headlines you need to keep an eye on as well. If it starts raising global growth worries, that's not going to be good for oil and commodities. So keep an eye on that one.
Ryan, one more thing we need to mention: cryptos. There has been stories, I don't know if you've read them, about Binance, the biggest exchange right now, and their potential audit, which they haven't done. And apparently there's been big outflows today on Binance. So there is more trouble potentially brewing for cryptos. And I don't need to say that if the Fed is hawkish, if the CPI is high, we're going a lot lower. It's going to be like a double whammy. So be very, very, very careful with crypto longs.
And even with that, Bitcoin's up 2 days on the trot. So it's a strange world over there, still.
It's a very strange world.
Technically, there's the level, or there's the area. And we're holding below. While it holds below, you got to think that it's going to take an awful lot of work to get back up above through that. But for trading, and if you're trading it, that's what you want to see. You want to see your defined levels. Where your risk lies and how to trade it. Right, on that note, I think we shall call it a session. Thank you very much as ever for coming to the Flow Show. Do trade safe over the CPI. If in doubt, stay out. If you're in our chat room, keep your eyes on all the different rooms, the general room, the Flyonomics room, where we'll be chewing over the numbers and letting everyone know exactly what we think it means for the Fed, for trading, what to do with it. And thank you to Stel, thank you to Kay for all your input as always, and we shall see you all tomorrow.
Thank you, everybody. Take care.
Good day, everybody.